All right, let's get right into it. While almost everyone is watching the S&P 500, the really big institutional players, the smart money, are quietly making a massive pivot. They're actually pulling out of the crowded world of public tech stocks. And what are they buying instead? Get this, local HVAC companies, plumbing businesses, stuff you'd probably never even think of as a serious investment. In this explainer, we are going to break down exactly why this is happening and what it signals for the future of investing.
So here's the plan. First, we'll look at why the public markets are getting so shaky. Then we'll dive into why boring is suddenly the hottest thing in investing. After that, I'll show you how to think like a private equity firm. We'll explore how regular people are starting to get access to these deals, and then we'll wrap up with the brutal, honest truth about the risks.
So the whole story really starts here, with a public market that just feels, well, unstable. All this nervousness is what's pushing smart investors to start looking for alternatives, for safer places to put their money.
I mean, we've seen some huge shocks to the system lately. Take the Great Unwinding. It sounds dramatic, but it was. Basically, investors were borrowing money super cheap in Japan and investing it elsewhere for higher returns. When that trade reversed, an incredible $6.4 trillion vanished from global markets. That's the kind of event that throws major indexes like the Nasdaq into a tailspin and justifiably makes everyone feel on edge. And look, these shocks aren't happening in a bubble. They're being mixed into this really nasty economic cocktail. You've got rising interest rates, which makes everything more expensive. You've got inflation that just won't seem to go away. And on top of it all, record high levels of debt. Put it all together, and it's no wonder people are getting really worried about a major recession coming our way.
So what do the big players do when they get scared? Well, you can see it right here. This is what we call a sector rotation. That smart money is pulling out of the high-flying, risky tech stocks, and they're moving it into what are called defensive sectors. Think utilities, healthcare, consumer staples. Why? Because people need electricity, medicine, and toilet paper no matter how bad the economy gets. It is a classic flight to safety.
Okay, so if the smart money is ditching the glamorous tech party, where exactly are they going? The answer is surprisingly boring, and that's where things get really interesting. What we're seeing is a huge shift in philosophy. For the last decade, it's all been about growth investing, right? Chasing the next unicorn, the next world-changing app. It's a high-risk, high-reward game. But the pivot is towards value investing. This is all about buying durable real assets that just churn out predictable cash, month after month. We're talking about things like a local plumbing business with decades of service contracts, not some app that might not exist in 2 years. It's about what is making money, not what might make money.
This is a perfect example. Take a sexy tech company like Netflix. Will it still be the king of streaming in 50 years? Honestly, who knows? The tech world changes in the blink of an eye. Now, look at a company like Swedish Match. They make tobacco products. A lot of people find that disagreeable, for sure. But is it predictable? You bet. It generates consistent, reliable cash flow. For a value investor, that boring predictability is way more attractive than a flashy headline.
So what does the perfect boring business look like? The checklist is pretty simple and kind of funny. It does something dull, like waste management. Even better, it might do something a little disagreeable, something other people turn their nose up at. It's usually an overlooked company that Wall Street pros aren't talking about at cocktail parties. And because of all that, it's not widely owned or followed by analysts. And right there, in that overlooked corner of the market, is where you can find incredible deals. Okay, so now we know what they're buying, but how do they know if it's a good price? To understand that, we have to put on our private equity hat and learn the simple, powerful math they use every single day. First things first, you gotta forget about stock price. Acquirers use something called enterprise value, or EV. Why? Because if you buy a company, you don't just get the good stuff, you also have to take on all its debt. EV calculates the real cost to buy the whole shebang, debt and all. It's the true takeover price. The next piece of the puzzle is EBITDA. It's a mouthful, I know, but just think of it as a company's pure, raw profit power from its actual operations. It strips away all the weird accounting and financing stuff to show you how much cash the core business is actually generating. It's the number that shows if the business itself is healthy. And here's where the magic happens. You take those two numbers and you combine them. You take the enterprise value and you divide it by the EBITDA. This creates a simple ratio, a multiple, that tells you everything. It literally tells you how many dollars you have to pay for every $1 of cash flow the business generates. The lower that number,
the better the deal you're getting. And there's a simple rule of thumb that these guys live by. If the multiple is under 10, that's considered a great value. It might be undervalued. You might even hear about small businesses being bought for 3 times EBITDA. That's a steal. If it's between 10 and 20, that's pretty standard, probably a fair price. But once you start getting over 20, whoa, that's starting to get really expensive. You're paying a huge premium for those earnings. It's this one little number that helps them hunt for bargains.
Now, this all sounds fantastic if you're a giant private equity firm with billions of dollars to throw around. But what about the rest of us? How can a normal investor get in on this action? Well, the game is actually starting to change, and some of those locked doors are creaking open. One way this is happening is through something called a SPAC. Think of it as a shortcut for a private company to get onto the stock market. Instead of going through the really long, complicated IPO process, they can just merge with a SPAC that's already public. And just like that, they're a publicly traded company.
The way it works is pretty simple. A manager, called a sponsor, basically creates an empty company and raises a bunch of cash from the public. That's why they call it a blank check company. Investors are trusting the sponsor to go find a good private company to buy with that check. If they find a deal and everyone agrees, the two companies merge. For a more hands-on approach, there are also search funds, where an entrepreneur raises money specifically to go find and buy one of these boring businesses to run themselves. And beyond that, there is an even crazier, newer idea on the horizon: tokenization. This is the concept of using blockchain technology to chop up ownership of a private asset into little digital pieces, or tokens, that people can buy and sell. This could be a total revolution. And here's why this could be such a game changer. Right now, there are these accredited investor laws that basically block 80% of the population from the best private deals. You need to have $1 million in assets or make 200 grand a year. Well, tokenization aims to blow that wall down. By creating tiny, fractional shares, it could let anyone, literally anyone, buy a small piece of a hot startup, a commercial building, or even a famous painting. So all this new access, it sounds amazing, right? Like finance is finally becoming democratic. But, and this is a huge but, it comes with some massive, often hidden risks, and you absolutely have to know what they are before you even think about it. Okay, let's just be real about specs. When you look at the data, it turns out that while they sound great for the public, they're often structured so that the sponsors who create them make out like bandits, no matter what happens to the stock price. We've seen big names that went public through SPACs just crater in value, wiping out public investors while the insiders had already cashed in. But here it is. The single biggest, most brutal truth of them all is illiquidity. This basically means once you put your money in, you can't get it out. Imagine buying a stock, but the sell button is just gone. Your capital can be locked up for 5, 7, maybe even 10 years. There is literally no exit map. You are on that ride until the very end, for better or for worse. So you have to weigh the promise against the reality. The promise is incredible, right? Get in on the ground floor of the next big thing, level the playing field. But the reality can be a nightmare. Your money is trapped, the deals are often tilted to favor the insiders, and you're playing in a brand new sandbox where the rules are still being made up, which means huge regulatory risk. Look, this pivot is happening. The smart money really is moving into these private, cash-flowing businesses. And now you have the playbook. You know what they're looking for and how they value it. But as these new ways to invest open up to all of us, they come with a really high price of admission. And it's not just about money. It's about your patience, your ability to have your capital locked up for years, and your stomach for some serious risk. So the real question is, can you handle that price?